Hey everyone, welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And Memo's missing. Memo is gone. So quick shout out to Memo. Check out your screen right now. You see Memo over in Egypt. He put sunglasses on a sphinx. He was holding up a pyramid from the top, and he got a ride with a new friend. So here's a quick message from Memo before we get into today's show.
Well, how's it going, my Mortgage Heroes family? This is Wednesday. I am sorry I am unable to attend our podcast. I am here with my buddy, my brother. We are here in Egypt trying to figure out a way how to finance these amazing pyramids. So we'll have to figure it out. We'll have to get innovative with it. We'll let you know how it goes. Right, hermano?
Yay!
My habibi, brother?
Yay, Talat!
All right.
Champion!
Beautiful place here. Look at this. We'll see you soon, guys.
And we'll have more news on whether he finances that pyramid or not on next week's episode, so make sure you tune in.
He's going to come back empty-handed. Like, hey, you know what? Those pyramids, they don't have keys.
Yeah, we walked them. We walked them. The inspection was not good. Turns out piping has been like, over thousands of years old.
The HOA's like, hey, your front yard's all sand.
Property taxes overdue a few.
Water bill. Okay, so today we need to talk about the Fed. So in case you missed it, last week the Fed had their press conference where they raised the interest rate by another 0.25%. That takes the target rate to 5 to 5.25. Yep. Jerome Powell, like normal, stood up there, Brian, and he gave a couple of prepared remarks, and then he took questions from the reporters. So let's just really quickly talk about what this means, because a lot of things were on repeat that he said before. Only a couple things changed, but we need to talk about them today. So
let's get right into it.
Yeah. So first things first, you saw that there's a 0.25% rate increase. The mortgage market didn't have too much of a crazy reaction to that, but of course, time is only going to tell. One of the big takeaways for me when they announced it is that no one was surprised.
Right.
Everyone had kind of been talking about, he gave enough hints at the previous meeting that this was going to be potentially the last one.
Right.
And there was a really high percentage of people wagering that this was going to be a 0.25% rate hike, which it ended up being. So no big surprise there.
Yeah, and I think one of the biggest things to take away from this is that if they only raised it up that much and signaled maybe that this might be a halt or it could be an opportunity for a halt, maybe things are getting a little bit better, but we'll get more into that.
Yeah, so whether or not there's going to be a halt, we're going to have to wait till the June meeting. That's the next time that they're going to get together, and we're going to see if they even do another rate hike or a pause. It did come up today. Hey, did any of the Fed board members bring up the idea that there will be a pause during today's announcement? The answer kind of was like, no, we didn't really talk about a pause because and then he kind of dovetailed that into this whole, well, we're being data dependent, and we're going to let the data approach be the way we look at what we do next, because we need to see the impacts and effects of all these choices, which they're starting to see. So that I think is a good sign, but in kind of the bad way, because the impacts they're trying to see is tighten lending standards, credit being difficult, easing, the job market. Yeah.
And I love how they put a job market easing, like we're just gonna ease it, like we're just, people need to get fired.
Yeah. and it sucks to say that.
And it does. It's like nothing makes sense.
Well, again, like I'm gonna go back to the math of this. They had said that they need to get unemployment to 4.5%. Well, if it's at 3.5 or 3.6, you need an entire 1% of workers to become unemployed by the end of the year. And that's, I checked the Bureau of Labor and Statistics another video ago, and the BLS.gov says we have 166 million people employed.
Wow.
So what's 1% of 166 million, Brian? 1.6 million people.
1.6 million people.
So we need 1.6 million people to be unemployed this year. That's a lot. Like, that's a lot.
So, and then that's, one of the things that I feel the real estate market is also, on the brink of, whether if that happens, how is that going to look like, as far as inventory for people that can't pay for their, house anymore, because they don't have that salary that's, holding them up to be able to,
that's right,
afford that payment or, that type of lifestyle. So that's also something to keep in mind, that if that does happen, we could see an influx of more listings listings, you know.
Yeah.
But then again, we don't know what's going to happen. So
and not just listings. That's for the people that own the house, have
or
a mortgage, foreclosures, but also potentially people that are renting and are going to become now the next wave of people evicted. Now, and again, I'm not saying these things are going to happen. It's just that when you stack up all these dominoes in a line and you tip the first one over, all those things start to cascade along the way. It includes their car payment, it includes their credit card payment. If they have a student loan, it affects that too. It's like everything gets impacted by loss of job.
And one of the things we spoke at, from previous is that, the first thing that they stop paying is for certain bills that they don't think that are, as important. And then that starts trickling down until the house. I mean, the house is the biggest payment, the most important
snowballs
one.
Up into that.
So that's going to be the last domino to fall here. And from what we've been seeing and, keeping track of, it's, getting closer to that. So we're just monitoring the data and seeing on a day-by-day basis where that's going and how, we can best prepare you guys at home to be able to pivot quick or, just have a great idea of it.
But to your point, like there could be a lot of listings out of this before foreclosure because again, there's so much equity still.
Of course.
So, I don't necessarily think that this is like evidence that there's like impending doom or anything like that. But I mean, we do have to keep an eye on the market very closely.
And I think that's one of the biggest reasons why I feel this is going to be a lot different if things do get a lot worse because of the fact of all the equity that people do still have in their house so that they can go turn around, sell the house, be able to cover what's left on the note and still, hopefully come up with some, money in their pocket to be able to offset whatever it is that they're going through. So all those things are still an opportunity or an option. We just yet to see, what happens next.
The one of the other things that kind of came up was about, banking and, confidence in the banking system. And, they kind of have to tread lightly with this one because as much as he's trying to tell everybody at this press conference, like, oh, yeah, we're confident in the strength of the banking system and its resilience. Everyone's like, you just had 3 of the biggest bank failures in history
Bank just got
in the last 90 days.
by the biggest bank, JP Morgan. And that's interesting because, to the consumer's eye and the regular everyday person, all they see is headlines: bank crash, major bank crash again,
bank fail.
So what do you expect people to feel like? This does feel a lot like 2008.
But it's
but they don't know any better.
But it's way different than when I come home. I'm like, oh, I forgot to stop and get eggs. Like I forgot on the way home. It's like this whole the banks are sound and resilient. Like they just saying it as casual as like, oh, I just forgot to pick up the dry cleaning on the way home. I'll do it tomorrow.
And is that what they said? Like, like our regulators, kind of dropped the ball on that. Well,
yeah.
What?
Well, it was kind of like not a backhanded admission, but kind of like an indirect admission that we might need to see different supervision and different supervision and regulation of banks of this size, because one of the things he's citing is the speed at which deposits can be taken or funds can be transferred because of the age of technology. But that's like the reaction to what's happening. So what's happening is that these banks are sitting on all these like treasuries that have an inverse relationship to interest rates. So when interest rates are pushed up by the Fed, the value of those treasuries goes down. And so the interest rates go up, the value of the treasuries go down, but these banks were holding so much of them that their value is getting sunk.
So at the time that people want to liquidate their money, since banks don't have that money liquid and it's tied into those investments, they have to sell out a loss, making everything offset and
if you have to liquidate something and you already took like a 20% haircut, like let's say overnight your car drops 20% value, but then you have to sell your car in order to get to put money back in your checking account. Like that's kind of what we're talking about in a very simplified term.
But I follow 100%.
But then what they state today is, we might need to supervise and regulate these banks differently because the speed and the way that technology, we have things to learn about that and maybe the new age of banking. And I'm like, but that was the reaction to what was happening. So people who knew what was going on we're taking money out, and then here we are at the press conference talking about, technology is one of the reasons why we need to maybe have different regulation.
Sure,
it's like,
okay,
but also here's the other thing, and I don't want to be all conspiratorial because now everyone's talking about the central bank digital currency, but the CBDC, central bank digital currency. Like he's saying in this press conference, we need to address the technological things that we have yet to learn. So the speed and that the reaction to the market can have a more swift response if there is anything like this in the future, which also kind of opens up that door to this whole central bank digital currency, which we know is coming.
100%. I mean, like you said, I think it's also a form of them being able to regulate them in their benefit because now they're the ones that are in control of everything that is coming in, coming out, moving in, moving out. So it's like at the end of the day, I feel it's just pushing it closer to what they already probably have planned down the line.
Yeah, and it's interesting that he mentioned technology in that sense. It was almost like it was in his advantage that the speed at which transactions can be made now is the reason for them to advance in their technology, but the advance of their technology allows them to introduce the thing.
I mean, it just basically feels like the government's ripping off Venmo and Cash App and saying, hey, we just found this new model.
I don't know that I necessarily care about that part.
Yeah.
I think I care way more about them deciding for you how and where you can spend your money.
Well, I mean, it's just like, I saw that Europe can't make transactions over $1,000 in cash anymore.
Wait, what?
Yes. And I'll pull up the article.
I didn't see that.
I'll show you.
Oh, wow.
Yeah. So I thought that's to whose benefit? Like, why would I want, what if I want to use cash? I just don't think they should be able to, manage that or see that.
Yeah.
It's just, but we'll talk about that.
Yeah.
Because,
that sounds like a whole different topic.
Yeah,
we need to actually, I want to talk about that one, but let's finish up and wrap up our Fed talk today.
Yes. All right.
Because, there were a couple of mentions today about, our target for inflation is still 2% over the long term. And he kept kind of referencing that there's like this time in the future off in the horizon.
Somewhere.
Now, in the past 6 weeks ago, they had a chart up, and that chart said that we'll have 2% inflation by 2025 is their projection. He did not say that today. He did not say 2025, but he's talking about this future time horizon where we will see a return to 2%, and that's their target. Even when asked if 3% would be a more maybe appropriate measurement, he was like, no. Not falling for that question. You're asking me if we're going to change our inflation target. So he kind of was like, nah, I got you. I hear your question. I'm not answering that. And no, our target will not change. It's going to be 2%. So that means we're in this for quite some time.
But honestly, if they weren't able to give you a clear path or a clear time, then they themselves don't have an actual timeline on when this is going to happen. So I just feel
they're not going to tell you.
That could be as well. I mean, that's a good argument because of the fact that if they do, then people will start doing things accordingly because they know things down the line are going to look a certain way. But I mean, it makes a lot of sense because everybody right now, historically speaking, when times like this occur, people are waiting for the Fed to come in and save the day because, they messed up or they just didn't do things the way that they were supposed to.
Right.
Whereas right now, I feel like it's getting to the point where people are like, Fed, where you guys at? And they're holding to their word, which in a way I feel is a good thing. But, how much more until, people can, keep things up.
How much more can they take?
Yeah, exactly. So
I think that's a huge problem. I mean, they talked about price stability, which is connected to that. And softening the labor market is part of that, and this below trend GDP. I mean, the whole whether or not our economy is expanding or contracting conversation is also part of that. Where how much more can people tolerate at the price levels they're being asked to pay month after month for the things that they consume every single month? And
we're not seeing the levels of income go up. People aren't getting paid more to compensate for the cost of living.
I'm glad you brought that up. So there was a question around that, and a question on whether or not the wage earnings were keeping up with inflation, and the answer is no, even though it wasn't asked that way. So the question is earnings outpacing historical earnings? The answer is yes. Wages are now historically hotter than they have been on average, but they're still chasing inflation. Yeah. So it's still less than inflation, but hotter than they have been trend-wise traditionally.
So basically still, I mean, you're making bigger in the long run, but
you might be making more, but things are costing more than the more you're making.
Yeah. Exactly. Hey, well, I mean, good bad news.
So, the other thing too is that, we have like an entire now full business week behind us of the new FHFA fee structure. And there's a lot of conversation around that. We already tackled that in the last podcast. So if you missed that one, you can go watch that other podcast and check that out. But I guess 1 week into this, I just want to mention in closing, you have the FHFA fees that came out. Then you had on May 1st, you had First Republic Bank that failed on May 1st. Chase acquires them. Then you have the Fed on May 3rd. There is a lot going on in May, and we have a ton of year left. And I think we're going to see a lot of pressure. Yeah. We're going to see a lot of pressure in the system. We're already seeing a lot of pressure in housing and mortgage. We're going to see even more pressure in banking, and we're going to see more pressure on FHFA.
And one of the things, I mean, just for here in San Diego, to give you guys an idea, even with everything happening in the economy, today we just got an offer accepted that outbid 30 people.
Whoa, what?
Yeah.
That means there's still 29 people looking.
Exactly. So
Wow.
my point blank period, like, the market is still gonna perform no matter what happens.
Wow.
And people's like life circumstances almost pushes them to need to buy a house. So
Well, yeah, everyone's got a place to live.
So I feel like, right now is the time to continue to stay up to date, know exactly what your next 2-3 moves are
Yeah.
going to be by planning, preparing,
Yep.
so that you could have the best information and best positioning when things do change for you.
Ask questions. Yeah, you
All
got
day.
questions right now. You want to talk
Ask.
to Brian or you want to talk to Will about what it is it's going to take for
And
you to get into a home. Do it now. Ask the questions.
Even if you don't think you're ready, start asking, how do I get ready?
Right.
What do I need to do to
Yeah.
get ready? Because those questions will start opening up answers that you don't know
Yep.
were there. And sometimes you're more ready than you think. And it's really just, paralysis by analysis. So
Yeah.
don't hold yourself back. Literally, people are still out there, and you do have the opportunity to get into a house if you have the right plan and structure.
Yep. Yeah, you definitely, more than ever right now, you have to have a plan and some sort of like plan of attack, like
of
a
course.
timeline and some real clear action points.
Intent and clarity.
Yeah. Okay. Well, there's a lot more we can talk about with the Fed and housing that is way too much in the weeds for this type of format of show. But what my encouragement is for anyone watching and listening today is, if you have questions about something you heard in the Fed press conference, or you want to know how that pertains and relates to your goals you're trying to accomplish in mortgage and real estate in 2023, give us a holler. You can put a comment in the comment box. You can also reach out to Brian or William directly. You can also direct message our office if you have any questions, so we can help you out, help you win in mortgage real estate in 2023. So
that's it.
And then next week we'll welcome William back, and he'll tell us about his Egypt trip, and we'll find out if he actually rode I don't even know if he rode a camel yet.
They
or
still
what.
have camels?
What do you mean they still have camels?
Just kidding.
They don't, like the camel factory didn't close.
Oh, they
Yeah, no, they're still pumping out camels. Yeah,
did they go electric though?
yeah. Well, there's hybrid ones, and you have to use a little bit of water. And
Okay,
then,
that's
they
what I
can
was
have
going to
the
ask. Do they
electric
use water
ones.
still? Okay.
Yeah. Mm-hmm.
Okay,
Yeah.
got it. Cool.
Yep.
Might have to hear first from William then. Yeah. See you guys next week.
Thanks for listening. We'll see you
Appreciate
next week.
Bye.